Ever get that feeling when you're trying to follow financial news and it's like everyone's speaking a language you almost understand but not quite?
Hmm.
You want to grasp the core ideas, the fundamental truths behind the numbers without needing to wade through endless details, right?
Yeah, absolutely. And that's precisely what we're diving into today on the deep dive.
Okay.
Think of this not as just another summary, but as a focused exploration designed specifically for you, drawing from the material you've shared.
Right.
Our goal is really to cut through the noise
Yeah.
and deliver those key aha moments that bring real clarity.
And today we're tackling the world of auditing and assurance. Our main source for this exploration is the book Auditing and Assurance Services, a systematic approach by Messier, Glover, and Prewitt.
hmm And knowing that you, as the learner, want to gain knowledge both quickly and thoroughly, we've distilled the essential elements of auditing. We'll navigate through the core concepts, trace the steps of the audit process, examine the crucial role of risk assessment, understand why internal controls are so important, and ultimately see how auditors arrive at their professional judgments.
Okay.
And believe me, there's some really interesting nuances to uncover.
Sounds good. So let's get started. In this deep dive, we're going to unpack the fundamental ideas behind auditing, then walk through the audit process from beginning to end,
Yep.
explore the critical role of figuring out where the risks are, understand why having good internal controls matters, and finally, look at how auditors form their opinions. Here's where it gets really interesting.
Well, what's fascinating when you first look at this book is its approach to learning. The authors really emphasize understanding the material, not just memorizing it.
Right.
They use lots of real-world examples, illustrations, and even analogies to help make some of these more complex topics really click.
Absolutely. It's not about just reciting definitions. The book actually has these stop and think moments that encourage you to actively apply what you're learning.
Exactly.
And I found the ongoing case study of Earthware Clothiers, that mail order retailer, incredibly useful. It really grounds the concepts in a practical business setting.
Yeah, it does.
It makes it so much more than just theory.
And that focus on clear and digestible information aligns perfectly with what we know you're looking for. Now, let's get to the fundamental question. Why do audits even happen?
Okay.
It all boils down to something called the demand for assurance. Essentially, audits are performed to provide confidence that a company's financial statements are free from what we call material misstatement.
Material misstatement. Okay, that sounds like a key term. What exactly does that involve?
Well, materiality is the idea that auditors aren't concerned with every single tiny error in the financial statements.
Oh,
Instead, they focus on misstatements, errors, or omissions that are significant enough to influence the decisions of the people who use those statements, like investors or lenders.
right. So, like, a typo doesn't matter, but leaving off $1 million does.
Exactly. Although, what's considered material is a matter of professional judgment. It can depend on the size and nature of the company.
Ah,
Think of it this way. A $100 error might be a big deal for a small startup, but totally insignificant for a huge multinational corporation.
makes sense.
So auditors act as a filter, focusing on what truly has the power to sway decisions. That's a crucial judgment call.
Okay, so they're looking for the big errors, the ones that could actually change someone's mind about the company's finances. That makes sense. Now, what about this concept of audit risk?
Right. Audit risk. It's the risk that an auditor might mistakenly give a clean opinion saying the financial statements are fairly presented, when in fact those statements contain a material misstatement.
So even if they do a thorough job, there's still a chance they could miss something important.
Precisely. The standard audit report even mentions reasonable assurance, right? And this acknowledges that inherent risk. Even with a very diligent audit, there's always some possibility that a material misstatement could slip through undetected.
Wow.
Auditors plan their work to reduce this risk to an acceptably low level. The more work they do, the lower the risk they take. But it's important to understand that reasonable assurance isn't the same as absolute certainty.
Right. It's a high level of confidence, but not a guarantee. Now, the book talks about management assertions. What exactly are these claims that the auditors are examining?
Okay, think of management assertions as the claims that a company's management makes about the numbers and the disclosures in their financial statements.
Okay. Like what they're saying is true.
Basically, yeah.
Yeah.
The book conveniently breaks these down into two main categories. The first relates to what happened during the period, the classes of transactions and events.
All right.
There are 6 of these: occurrence, completeness, authorization, accuracy, cutoff, and classification.
Okay, that's a good list to have. Can you give me a quick example to illustrate one or two of those?
Sure, let's take occurrence. This assertion basically means that the sales transactions that the company has recorded actually happened and pertain to the company.
Got it. They weren't just made up.
Exactly. So an auditor might look for supporting evidence, like shipping documents, to confirm that the sales they see in the records correspond to actual goods being sent to customers.
Okay.
Another one is completeness, which means that all the transactions and events that should have been recorded have been recorded.
Ah, so checking for missing things too.
Precisely. They're not just checking if what's there is real, but also if anything is missing. A key implication here is that auditors have to think about not just what's in the financial statements, but also what should be there.
Right, so they're checking both directions, that the numbers are real and that all the right numbers are included. What's the second category of assertions?
The second category deals with how things are presented and disclosed in the financial statements.
Okay, the notes and stuff?
Yeah, exactly. There are four of these assertions: occurrence and rights and obligations, completeness, classification and understandability, and accuracy and valuation.
Okay, similar ideas but applied to how the information is shown. Can you give an example here as well?
Sure. For completeness, in this context, it means that all the necessary disclosures, those footnotes you often see at the end of the financial statements, have been included.
Mm-hmm.
For example, if the company is facing a significant lawsuit, the completeness assertion means those details, which could be important for users to understand the financial picture, are disclosed.
I see.
These assertions really form the framework for what auditors need to gather evidence about to form their opinion. Understanding these management assertions is crucial because they essentially become the targets that auditors design their procedures to test.
This is giving me a much clearer understanding of the fundamental goals of an audit. So now that we've got these core concepts down, let's talk about how an audit actually happens, the audit process itself.
Okay, yeah. The book outlines a pretty logical flow for an audit. It begins with the auditor getting to know the client really well, their business, their industry, the risks they face, and their internal system.
Right, doing that homework.
Exactly. Then, based on this understanding, the auditor develops a plan outlining the specific steps they will take to gather evidence. This evidence is what ultimately backs up their opinion on the financial statements.
Okay.
Think of it like a detective building a case they need to understand the scene of the crime before they can start looking for clues.
That's a great analogy. So what are the main stages in this audit journey, according to the book?
Well, the process kicks off with preliminary engagement activities.
Okay.
This involves deciding whether to take on a new client or continue with an existing one, putting together the audit team, making sure everyone involved is ethical and independent, which is absolutely crucial for trust in the audit,
Super important, yeah.
and establishing a clear agreement with the client about the scope and terms of the audit.
So it's about setting the ground rules and making sure everyone is on the same page before any actual audit work begins. What comes after that initial stage?
Next comes planning the audit. And this is a really critical phase.
Mm-hmm.
This is where the auditors develop their overall strategy and detailed plan for the audit. It includes assessing the client's business risks, things that could go wrong,
Right.
figuring out what level of misstatement would be considered material, considering if the client has multiple locations or needs specialized expertise, like maybe IT specialists,
Okay.
and also looking at things like compliance with laws and regulations and identifying any related parties. They might also think about other services they could offer that would add value for the client.
Wow. A lot goes into just planning the audit itself. It sounds like a very strategic and thoughtful stage.
It absolutely is. Proper planning is the foundation of an effective and efficient audit. It's during this phase that they make their initial assessment of risks and determine the levels of materiality we talked about. This planning also heavily considers their understanding of the company's internal control system, which we'll delve into more shortly.
Okay.
For companies that are publicly traded, this planning is even more involved because auditors are required to not only audit the financial statements, but also provide an opinion on the effectiveness of the company's internal controls.
Ah, right. The integrated audit.
Exactly. The result of all this planning is a detailed written audit plan that outlines the specific audit procedures the team will perform.
Okay, so after all that strategic planning, what are the next steps?
The next major phase is auditing internal control.
Right.
This involves gaining a deep understanding of the client's internal controls, the processes and policies they have in place to prevent or detect errors, and then testing how well those controls are actually working.
Seeing if the system actually functions.
So is it right. Following that is auditing business processes. This is where the auditors really get into the details of the company's operations,
Okay.
looking at specific areas like how they generate revenue, how they make purchases, how they manage their inventory, examining the transactions and account balances related to these activities.
So digging into the actual numbers.
Yep. When auditing revenue, for instance, auditors might trace a sample of sales invoices back to shipping documents to verify occurrence. That kind of practical detail.
That sounds like the core of the audit work, really digging into the numbers and the processes.
Exactly. After auditing the business processes, they move into the completing the audit phase.
Okay. Wrapping up.
Yeah, involves final reviews of the work done, assessing any potential future obligations or uncertainties the company might face, and getting formal statements from management about the financial statements.
The rep letter.
The management representation letter, yes. Finally, the last phase is evaluating results and issuing the audit report, where they pull together all the evidence they've gathered and form their professional opinion on the financial statements.
And throughout all these stages, I remember reading about sampling. Why is it that auditors usually look at only a portion of the transactions?
Sampling. Yeah, that's primarily a matter of practicality.
Just too much data.
Way too much, usually. Due to the limitations of both cost and time, it would be incredibly difficult, if not impossible, for auditors to examine every single transaction that a large company might have.
Right.
Instead, they use various sampling techniques to select a representative subset of transactions to examine.
Okay.
The idea is that if the sample is chosen carefully, it should give them a reasonable basis to form an opinion on the entire set of transactions.
Okay, that makes logical sense. It's about getting a good enough picture without having to look at every single detail. Now, let's go back to something you mentioned earlier that seems really important. Risk assessment. This sounds like it's a fundamental part of the whole audit process.
It truly is the backbone of the audit. The book emphasizes that auditors need to understand the client's business, risks, the things that could threaten their objectives,
Uh-huh.
and how those risks could potentially lead to material misstatements in the financial statements. They look for various conditions and events that might signal these business risks.
What kind of conditions or events are we talking about here?
Well, it could be factors related to the industry the company operates in. For instance, really intense competition in an industry might create a risk that a company inflates its sales figures to look better.
Pressure?
Or it might lead to a risk that their inventory becomes obsolete and overvalued because they can't sell it at the prices they expected.
Ah.
Or it could be specific to the company itself, like if they have really complex transactions or if they have high turnover in their key accounting personnel.
Yeah, that could cause issues.
Right. Or if a company holds high-value inventory that's also easily stolen, that presents a very different type of risk that the auditors would need to consider.
So they're looking at both the big picture, the industry, and the specifics of the company to try and identify potential areas where things could go wrong.
Exactly. And a central part of this risk assessment process is gaining a thorough understanding of the entity's internal control system.
Right.
This is absolutely vital for planning the audit effectively and assessing the likelihood of material misstatement.
Internal control system. That sounds like the processes and procedures a company has in place to safeguard its assets and ensure the accuracy of its financial records. Is that about right?
That's a perfect way to describe it. The book highlights 5 key interconnected components of internal control.
Okay, 5 components. What are they?
There's the control environment, which is the overall culture and ethical values of the organization, the tone at the top.
Okay, the company culture part.
Yep. Then the entity's own risk assessment process, so how they identify and respond to their own business risks.
How they manage risk themselves.
Right. Then control activities, which are the specific actions taken to mitigate risks, the policies and procedures.
Like approvals and things.
Exactly. We'll talk more about those. Then information and communication. How relevant information is identified, captured, and exchanged.
That stuff gets communicated.
And finally, monitoring activities, which are the ongoing evaluations to see if the controls are working properly over time.
Got it.
Each of these components plays a crucial role in helping the company manage its risks.
Control environment. So that's about setting the tone at the top and having a culture of honesty and ethical behavior throughout the company.
Exactly.
Yeah.
It really sets the foundation for how seriously the company takes internal controls. Then there's the company's own risk assessment process, how they identify and analyze the risks relevant to achieving their financial reporting objectives. Control activities are the concrete actions, the policies and procedures that help ensure management's directives are carried out.
And what kind of specific control activities are we talking about? Can you give some examples?
Sure. Think of things like requiring approvals and authorizations before certain transactions can be processed,
Okay,
or verifications and reconciliations where they're checking one set of records against another to make sure they match. Bank recs, for example.
right.
Segregation of duties is another really important control activity.
Ah, I've heard of that.
Yeah, it means dividing responsibilities among different people so that no single individual has too much control over a particular process. For example, the person who handles cash shouldn't also be the one who records the cash transactions.
Right, prevents temptation or mistakes.
Exactly. These checks and balances are crucial.
That makes a lot of sense. It's about having those checks and balances in place. What about the other components you mentioned? Information and communication, monitoring.
Right. Information and communication refers to how the company captures and shares important information, both within the organization and externally, to support the functioning of internal controls. You need the right info, getting to the right people at the right time.
Okay.
And finally, monitoring activities are the ongoing processes the company uses to assess the effectiveness of its internal controls over time and take corrective actions when needed. It's not a one-and-done thing.
So it's a comprehensive, integrated system designed to prevent mistakes and catch any potential fraud. Now, you also mentioned IT controls earlier.
Very important now.
With how much businesses rely on technology these days, how do computers and IT systems fit into all of this?
Well, given how essential technology is to modern business operations, IT controls have become increasingly significant.
I bet.
Auditors need to understand these controls, how data and transactions are entered, approved, recorded, processed, and reported within the IT systems.
Yeah.
They might even need to involve IT specialists on the audit team to help them assess these more complex technical controls.
Makes sense.
When you think about the sheer volume of electronic data and the potential for sophisticated cyber threats, you can see why IT controls are so critical.
Absolutely. That adds a whole other layer of complexity that auditors need to be aware of. Now, I remember seeing a distinction in the book between a material weakness and a significant deficiency in internal control. What's the key difference between those two?
Good question. Okay, so a control deficiency exists when the design or operation of a control doesn't allow management or employees to prevent or detect and correct misstatements in a timely manner.
Okay, so control isn't working right.
Right. Now, material weakness is a more serious type of deficiency or combination of deficiencies, such that there's a reasonable possibility that a material misstatement in the financial statements will not be prevented or detected and corrected on time.
Okay, so that's the big one. Links back to materiality.
Exactly. A significant deficiency is less severe than a material weakness, but it's still important enough to bring to the attention of those in charge of governance, like the board of directors or the audit committee.
Okay.
So yeah, a material weakness poses a higher risk of a significant financial error going undetected.
So a material weakness is the more serious issue, indicating a higher chance of big problems slipping through the cracks. Can you give me a quick example of a control activity maybe related to IT to illustrate how these controls work in practice?
Certainly. Let's consider a payroll system again.
Okay.
A limit test could be implemented as a data validation control within the system.
A limit test.
Yeah. This control could be programmed to automatically flag any payroll transaction where an employee has worked more than, say, 80 hours in a week.
Ah, okay. That seems high.
Right. It would flag it for review and approval before it's processed. This kind of automated control helps to ensure the accuracy of the payroll data by preventing potentially erroneous entries.
That's a really clear example of how technology can be used as a control to improve accuracy. So after auditors have assessed the risks and gained an understanding of the internal controls, the next crucial step must be actually gathering the evidence to support their opinion.
Exactly. Now we get to the evidence gathering. Auditors perform specific audit procedures, which are the actions they take to gather the evidence they need.
Okay.
And the book details a wide range of these procedures.
Like what specific kinds of procedures are we talking about? What's in their toolkit?
Well, there's inspection, which involves examining the client's records, documents, or even physical assets, like counting inventory.
Right, looking at things.
Yeah. Observation is where the auditor watches company personnel performing their tasks.
Okay.
Inquiry involves asking questions of management and employees. Sounds simple, but it's key.
Talking to people.
Confirmation is the process of getting information directly from third parties like banks or customers to verify the company's records.
Getting outside proof.
Exactly. Recalculation means the auditor independently checks the mathematical accuracy of a client's calculations.
Checking the math.
Reperformance involves the auditor independently carrying out procedures that the client has already performed.
Doing it themselves to check.
Right.
Yeah.
Analytical procedures are evaluations of financial information made by studying plausible relationships among both financial and non-financial data, looking for trends, anomalies.
The red flags we talked about.
And finally, scanning involves reviewing accounting data to identify any significant or unusual items that might warrant further investigation.
Wow. That's quite a toolkit of techniques they have available.
It is. They choose the procedures based on the risks they've identified.
That makes sense. Now, how do auditors determine which evidence is considered good or reliable evidence? Is some evidence better than others?
Oh, absolutely. The reliability of evidence is key. Generally speaking, evidence that is obtained from independent sources outside of the company is considered more reliable than evidence that comes solely from within the company itself.
So, getting a bank confirmation directly from the bank is considered stronger evidence than just looking at the company's internal bank statement.
Precisely. That's a classic example. Also, evidence that the auditor obtains directly is usually better than evidence obtained indirectly.
Okay.
And evidence that has been subjected to strong internal control within the client's organization can be considered more reliable. For example, a well-controlled electronic document management system might provide more reliable documentary evidence than, say, loose paper documents.
Right. Makes sense. What about those external confirmations you mentioned? How are those actually used in practice?
Confirmations are a really valuable audit tool. They're used quite extensively to verify balances like accounts receivable.
For contacting customers.
Exactly. Directly contacting the company's customers to confirm how much they owe. Or accounts payable by contacting suppliers to confirm how much the company owes them.
Oh.
They can even be used to confirm things like inventory that the company might hold on consignment at another location, providing evidence of the company's rights and obligations related to that inventory.
Interesting.
Generally, confirmations are considered strong evidence for the existence assertion, confirming that an asset or liability actually exists.
Gotcha. And you also mentioned analytical procedures. How do those help auditors gather evidence?
Right, analytical procedures. They involve looking at relationships in financial data. For example, an auditor might compare the company's current year revenues to prior year's revenues.
Yeah.
Or they might compare their gross profit margin to industry averages.
Looking for inconsistencies.
Exactly. Significant unexpected differences in these relationships can indicate potential problems, like a potential misstatement in revenue or cost of goods sold.
Right.
Auditors use these procedures not only in the planning phase to help identify areas that might be riskier, but also as substantive procedures later on to look for these unusual trends or relationships that could suggest a material misstatement. It's about looking for things that don't seem right or don't fit the expected patterns.
So it's like looking for red flags in the data by seeing if things are out of line with expectations. Now, we talked a bit about sampling earlier. Let's delve a little deeper into that. It sounds like there's a whole methodology behind selecting what to test.
There truly is. As we discussed, sampling is a practical necessity for keeping audits cost-effective.
Yeah.
However, because auditors are only examining a portion of the transactions, there's always a risk that the sample they've chosen might not accurately reflect the characteristics of the entire population of transactions.
Right.
This inherent uncertainty is what we call sampling risk.
So it's the risk that their conclusions based on the sample might be different from the conclusions they would have reached if they had examined every single item.
Exactly right. And the book highlights that there are two main types of decision errors that can occur because of sampling risk.
Two types. Okay.
The first is the risk of incorrect rejection. This is where the sample results lead the auditor to believe there's a problem, when in reality the entire population is fine.
Ah, a false positive.
Kind of, yeah. In the context of testing internal controls, this is sometimes referred to as the risk of under-reliance, or assessing control risk too high. It could lead to the auditor doing more work than is actually necessary.
Okay. Inefficient maybe, but not the worst outcome.
Right. The second, and generally more concerning, is the risk of incorrect acceptance.
That sounds worse.
It is. This is where the sample results suggest that everything is okay when there's actually a material misstatement in the financial statements, or the controls are not effective. In a financial statement audit, this is also known as the risk of over-reliance.
Both of those sound like they could cause issues. Incorrect rejection might lead to wasted effort, but incorrect acceptance seems like the more dangerous one where they could miss a real problem with the financial statements.
You've hit on the key point. Incorrect acceptance is the more significant risk from the perspective of audit effectiveness. That's the one auditors really worry about.
So how do they manage that risk?
Well, to manage sampling risk, auditors consider factors like the confidence level they want to achieve, how certain they want to be in their sample results,
Okay.
and the tolerable deviation in controls testing, which is the maximum rate of error they can accept without concluding the control is ineffective,
Hmm.
or tolerable misstatement in substantive testing, which is the maximum amount of misstatement they can accept without concluding the financial statements are materially misstated.
Okay, setting thresholds.
Exactly. These factors directly influence the size of the sample they need to select. Generally, the higher the desired confidence and the lower the tolerable deviation or misstatement, the larger the sample size will need to be.
That makes sense. A larger sample gives you more confidence in your results. So, after all this detailed risk assessment and careful evidence gathering, the ultimate goal is for the auditor to form an audit opinion. What different kinds of opinions can an auditor issue?
Right, the opinion. The most common and the most desirable outcome is an unqualified opinion.
Unqualified. That sounds bad, but it's good.
Huh. Yeah, the terminology is a bit counterintuitive. It's often referred to as a clean opinion.
Okay, clean opinion. Got it.
This is what's issued when the auditor has obtained sufficient appropriate audit evidence and concludes that the financial statements are presented fairly in all material respects in accordance with the applicable accounting framework, like GAAP.
So that's the best outcome, the one that indicates everything looks good, materially speaking. What happens if the auditor can't issue an unqualified opinion?
In those situations, the auditor will issue what's known as a modified opinion.
Modified, okay.
There are several types of modified opinions. A qualified opinion is issued when there is a material misstatement in the financial statements that is not pervasive.
Not pervasive, meaning it doesn't affect everything.
Right. It affects specific parts of the financial statements, but doesn't undermine the overall fairness. Or a qualified opinion might be issued if there's a limitation on the scope of the audit, meaning the auditor couldn't obtain enough evidence for a particular area.
Okay, so a qualification is like a but.
Kind of, yeah. It's fair, except for this one thing. Then there's an adverse opinion.
That sounds bad.
That is bad. It's a more serious finding. It's issued when the auditor concludes that the misstatements in the financial statements are so material and pervasive that the financial statements as a whole are not presented fairly.
Wow, so that's a major red flag.
Huge red flag. Finally, a disclaimer of opinion is issued in cases where there is a very significant limitation on the scope of the audit.
So they couldn't do their job properly.
Exactly. So pervasive that the auditor simply cannot form an opinion on the financial statements. Or, in very rare cases, if the auditor lacks independence, they basically say we can't give an opinion.
So it's a spectrum of opinions ranging from everything looks good to there's a significant problem to we couldn't even get enough information to say. What about those extra paragraphs you sometimes see in audit reports? Emphasis of matter.
Yes. Emphasis of matter paragraphs and other matter paragraphs.
Right.
An emphasis of matter paragraph is included in the audit report to draw the user's attention to a matter that is appropriately presented or disclosed in the financial statements, but is of such significance that it's fundamental to their understanding.
Like what?
A common example is when there's significant uncertainty about the company's ability to continue as a going concern. The paragraph doesn't change the opinion, but it highlights this crucial issue.
Okay, points out something really important.
Yep. Another matter paragraph is used to communicate matters other than those that are presented or disclosed in the financial statements that the auditor considers relevant to the audit, the auditor's report, or the financial statements. This could include things like restrictions on the use of the auditor's report.
So these additional paragraphs provide important context or highlight key issues for the people relying on the financial statements. Now, I know there are different rules and standards for public versus private companies. How does that distinction affect the audit report?
That's a really important point. For public companies in the United States, the audit report has a specific title, Report of Independent Registered Public Accounting Firm.
Okay.
And it states that the audit was conducted in accordance with the standards of the Public Company Accounting Oversight Board, or PCAOB.
PCAOB for public companies. Got it.
For private companies, the report is typically titled Independent Auditor's Report and refers to Generally Accepted Auditing Standards, or GAAP, issued by the Auditing Standards Board, or ASB.
GAAS for private. Okay.
Additionally, and this is a big difference, for public companies, there's a requirement for that integrated audit we mentioned,
Right.
meaning the auditor not only gives an opinion on the financial statements, but also expresses an opinion on the company's internal control over financial reporting.
Two opinions in one report, basically.
Essentially, yes. This is generally not required for private companies, though they still need to understand internal controls for the financial statement audit itself.
So the audit report for a public company has a heavier focus on internal controls in addition to the financial statements themselves. Well, this has been a truly illuminating deep dive into the world of auditing and assurance.
It's a complex area.
It really is. We've covered so much, from the basic reasons why audits are necessary to the very detailed steps of how auditors gather evidence and ultimately arrive at their professional opinions.
Yeah, we've highlighted the central importance of focusing on material misstatement and understanding audit risk, the systematic and logical nature of the audit process, the critical role that internal controls play in preventing and detecting errors and potential fraud,
Absolutely.
and the different types of opinions that an auditor might issue depending on their findings.
Hopefully, this deep dive has provided you, our listener, with a solid foundation for understanding the fundamentals of auditing. This knowledge should empower you to approach financial information with greater confidence and maybe a more critical perspective.
Absolutely. And as you encounter real-world business events and financial news, we encourage you to consider how these auditing concepts might apply.
Yeah.
Think about that delicate balance between the cost of performing an audit and the value that a reliable audit provides to the users of financial statements.
That's a good point.
Or how the role of auditors might continue to adapt and evolve in our increasingly complex and data-driven business environment. Things like AI are changing the game.
Definitely something to think about. What further questions might this deep dive have sparked for you about auditing and assurance? Perhaps you'll be interested in revisiting the book with this new understanding or exploring related fields like forensic accounting or internal auditing.
Thank you for joining us for this in-depth exploration. We trust it has given you clarity and maybe a few valuable aha moments.